Hey, welcome back, everybody, to today's Market Explained, the FourStar podcast series, long running. I'm Brian Castle, your host. I'm here with Mr. Chris Reardon. Chris, welcome again as my co-host.
Thank you, Brian. Glad to be here. Glad to talk a little bit about the markets.
And for those of you who don't know, Chris is our director of development at FourStar. I call him the master of all things portfolios, trading. He does advisor development, and he works with all the advisors on products and just incredible work. And he's a Cleveland boy, still loves the Indians, I'll call them. Guardians, right?
Guardians now, but yes, the Indians are still a beloved name, if you will.
And he's a young dad with a daughter and two twin boys. So welcome to Chris and his whole family.
Thank you, Brian.
And I'm Brian Castle. As I mentioned, I'm the CEO and founder of FourStar Wealth Advisors. I'm an advisor to CEOs and insiders. I'm a trustee of the National Boy Scout Foundation. And I'm chief dad to Quinn and Evan, husband to the amazing Tripty. I wish everybody can enjoy this program. And if you think of it, send a copy of it to your friends. And if you get to smash the 5 out of 5 button, that would be great as well. So we get the best rankings that we can. We'd appreciate that. But we've been ranked in the top 1% of financial podcasts for a number of years now. We want to stay there and expand the whole program. So we're going to talk a little bit about the markets today, but a little bit about the economy. And then we're going to talk about just some unique things that we see out there. Chris, what does it look like in the markets today? The relationship between all the different stocks, bonds, commodities. Give us the rundown.
Yep. So kind of interesting movement we're seeing. So this is kind of in comparison to our last podcast, which was really the beginning of March. So kind of a little past halfway into March now, the changes we're seeing are starting to really stack up. Domestic equities is still in the number 1 position, but it lost 16 points. So that's the most we've really seen that deteriorate probably since 2022 now, kind of coming out of that. So it's at 303 tally points. But, significant deterioration in that number 1 position. Conversely, commodities in the number 2 position, it only gained 1 point, so it didn't gain as much, but it's at 273 now. And we're really starting to see that gap close. So there is now, I think, more realistically becoming the potential for commodities to potentially take that number 1 position. We'll see. Obviously, commodities can be volatile as well, but it seems like the way that commodities have held up, when one has weakened, it seems like another one has kind of taken over. Gold and oil, especially, have been really kind of moving upwards as of late. So international equities continues to be in the 3rd position, but I think this is probably the more interesting story here because it gained 8 points. So we're starting to see a little bit of life out of that international equities. And it was the main benefactor from that move downward from domestic equities. So, that trend's interesting. Are we seeing people move out of the, domestic or US markets to more international markets? Are those becoming more attractive? We'll have to just see. But cash remains in the 4th position. We saw a +3 movement there to 131. So we never want to see cash really start to gain points. That usually means the markets are getting very, very bad. And there's really no place to go. Even if domestic equities moves to 3rd, if international is doing well, we can always move kind of more or skew towards the international market. So we never want to see cash gaining that much, but it did only gain 3. It still has a ways to go. Almost 100 points behind the number 3 position, but any move upwards, obviously, we watch. Fixed income gained 4 points. It's at 85 in the 5th position, and currencies still dead last at 78, and it was actually unchanged. It was the only one that was unchanged. So
okay. So Chris, these relationships are changing. Domestic stocks, equities are going down, commodities going up, international's going up, but commodities are actually going up. Relative and absolute, because there's things that are going up, but international equities are still going down, but just not as much as domestic equities, right? That's why they're gaining.
International equities, there's definitely been, on a broad basis, it's probably been down, but there's definitely been hot spots, if you will. Some of them being Germany, things like that, where we've seen some better movement as of late. But it's definitely when we're talking any of these sectors, there's winners and losers. We're talking broad, and when you look at the broad market, it's been flat to down, I would say.
Well, and we've had the longest rally in quite a while relative where international stocks are doing better than U.S. stocks for about 8 months last year, but then it faded again. And we haven't really had a sustained rally in international stocks since like 2006. I mean, it's been a long time. And that between the tech crash of 2002 and then the Great Recession in 2008, that international did the best during that period of time, along with commodities. But we really haven't seen like a 2 or 3 year stretch where international's done well. And so that last year's rally ended in about 8 months. So we really haven't seen a sustained international rally, but we're always hopeful. We're always watching. Right.
Yeah, I mean, I would say the one concern with the international, at least in my perspective, is the foundation it's built on is pretty shaky. Just looking at the regional and geopolitical kind of politics. I mean, you have the Russian-Ukraine conflict, you have escalating tensions in the Middle East, so it's something that could be knocked off kilter, pretty easily. So definitely something to keep an eye on. But at least in the short term, right now, we're seeing a little bit of gains out of it. So
Yeah. Well, and all the markets have turned down. Now the S&P 500 is down 4% for the year. Now the Nasdaq, the big tech names, those have been down more than 10, and they're down about 12 now. So they're getting hit badly, but they were up so much. So a lot of people are still just giving back gains, and sometimes people get lulled into, oh, hey, I'm just giving back a little bit of my gains. But you got to be really careful there because that can happen very, very quickly. And so watch it, everybody, if you're trading in those high octane names. So S&P is down about 4. The Dow Jones, though, is actually doing a lot better. It's only down about 1.8, and it's just kind of falling under the weight of all the markets. And then, of course, like I mentioned, the Nasdaq is down substantially for the year. It's back down to only about down 8%, but it had been down more and had been in correction territory. So we're getting all of our signals now, Chris. We stay mostly fully invested, but in markets like this, we raise cash, and there's 4 different positions where we can do that. We went to position 3 actually, and we just got the signals this week to go to position 4, and we're pretty much sure we're going to take the maximum protection level. And then, Chris, that hasn't happened since 2022, and it's only happened 8 times now. If we do this maneuver 8 times in 30 years, so it's a pretty big deal.
Yeah, no, I mean, it's definitely a big deal. And I think it's pretty, I don't want to say amazing, but pretty crazy that it has happened probably since in the last 10 years. I think it's happened 3 or 4 of those times. You had 2022 cycle, you had 2020, the COVID pandemic, you had 2016, which was a volatile market. So, I mean, really interesting. When you really think about it, these kind of mini cycles, I would say, the markets in general, I think people, when you pull back and see is, if you take it on a 10-year basis, have been up, but they've been much more extremely volatile in these short mini cycles. I would say probably the most long-term of them really was 2022, was the most actual kind of a bear market, but the other ones were more characterized by almost like a quarter or 2 of extreme volatility downwards, followed by kind of a quick bottom and move upwards. So it'll be interesting. I mean, we don't know what's gonna. I think the hard part is we don't know what's gonna happen moving forward.
Yeah.
Obviously, with the administration now, there's a lot of changes happening, which I think is impacting. Once those get digested, is that going to change? There's a lot of unknowns and a lot of variables out there that no one really knows, quite frankly.
Well, and then we have 40 different indicators, and we have a weight of 60. Some indicators have more than others, but most of them have turned negative now. So it's about as bad at internals as we've ever seen it. Now, then people might say, well, if you're doing this protection, then you're really hoping the market goes down. And I want to be real clear about that. We are not hoping the market goes down. We would be delighted if the market goes down, stops going down today, the minute we do the sales, because we'll just get right back in. We have a system to get back in, but we have been gaining all along. As the market has been selling off, we've been raising cash. So the market's down 2%. We're down maybe 0.5%. So we're not down as much. So we have some outperformance here in the last couple of weeks because we've had a lot of cash. We're going to go to the maximum cash level. And if the markets keep going down, then we have that protection. We're just raising cash for protection. And we're not predicting it's going to go down. The probability numbers are saying it could likely do that, but we're not trying to predict it. And we're not hoping it goes down. We want it to go up. And we, again, like I said, we'd be delighted if it turned around and went up. So we're up market people. All we're doing is protecting the downside so people don't lose 50%. If you lose 50% of your portfolio in a bad bar market, it's going to take you a decade to make that money back. And we don't want to do that to people. And that's why we designed this program. So I guess the message today, Chris, is that as of today, we're maximum cash for the 8th time in 30 years.
Mm-hmm. Yeah, I mean, I think as of today, we'll be moving to that, maximum cash position. So, and I think it's interesting. I mean, I don't know what it speaks, and we don't know what this recent downturn is going to bring, how long it's going to last. But I think it is interesting that really in the last 3 years now, this is the second time in the third 3-year period. So obviously 2022. So. Yeah, it's definitely going to be interesting to kind of see what this brings, but we are defensive right now, and hopefully the markets, like you said, turn back around. And if they do, like you said, I think we would be delighted. We'll overweight the sectors we need to. That might be characterized by a tech run again, kind of off the bottom. Who knows? We'll identify those and we'll put more weight to those, and gain back some of the momentum lost if we did have a reversal.
Yes. So that's what we see. Now, why don't we talk about what's causing all this, Chris? You have some economic numbers. Why don't we talk about that?
Yeah, I mean, it's definitely a big mix on the economic front. From the inflation, we're seeing tepid inflation or kind of a slowdown, which is good. That's actually overall positive. The CPI came in at 2.8% in February, year over year. That was actually down from the January 3% year over year number, and actually beat expectations by 0.1%. So that was good to see. And I think even more importantly, core CPI, which excludes volatile categories like food, energy, that came in at a 3.1% year over year number, which is the lowest reading since 2021. So some good news from that front. But I think what's worrying the markets now a little bit is the deteriorating consumer. The consumer's been one of the kind of growth engines of the economy. And I think that was, in some cases, an unknown variable. I mean, a lot of people predicted a year ago today that we were going to have a recession. And they were kind of predicting it. We're going to see a slowdown. And it never really came fully to fruition. And a lot of that was because the consumer kept spending. The consumer kept, driving things forward, which was good to see. So people are worried about that. The University of Michigan Consumer Sentiment Index came out and it dropped 11%. To 57.9, and that's a mid-March reading. It was at 64.7 last month. That's the lowest that level's been since November 2022, so really that last recession. And more importantly, the index is down 27% from a year ago. So, obviously sentiment is worrisome for some people out there. And more importantly, February retail sales came in 0.2% month over month. And that was below expectations of 0.6%. So, we don't really know yet, but is this a sign that the consumer is starting to roll over and they're not going to spend as much, they're going to save? And that would, I think, be one of the paths that we would see to start, putting us on the path towards a recession if we see that consumer rollover.
Yeah. Well,
go ahead, Brian.
Go ahead, Chris. Go ahead.
I was going to say on the job market front, I think that's kind of actually still holding up well, bright spot. Initial jobless claims for the first week of March came in at 223,000. It was pretty much on market, actually slightly beat the estimates at 224,000. But then continuing jobless claims for the last week of February were 1.87 million, which beat estimates of 1.9 million. So we're still seeing a relatively better job market, which is good. And then on the industrial front, we're seeing mixed signals. The New York Fed Manufacturing Index came in at a -20, which was way worse than the expectations of a -1.5. So that's significant contraction there. And then but on the February industrial production came in at 0.7% month over month, which was way above expectation. So 0.2%. So we're seeing mixed, obviously one is pointing to a significant contraction. Another one, production wise is still proving strong. And then I would say the last real quick piece I'll highlight is the housing continues to be, I think, in focus. Building permits for February came in slightly above estimates. but we're still down 1.2% from January. And then housing starts in February, beat expectations at 1.5 million. So, that's interesting that, I think that what's going to be tough there, and we've talked a lot about the housing market on this podcast, is affordability. You can build as many houses as you want. If those houses you're trying to sell are $1 million, a lot of people can't afford them. So, that affordability, I think, is going to be a key factor there. And I'm sure that's what a lot of these builders are looking at. So, it's going to be important to, I think, keep an eye on is not only are they continuing to build houses, but if they are continuing to build houses, I'm sure they're building them because they're confident they can sell them. And so it's important to watch that. If we do see that roll over, that means, not a good sign, at least in the short term, for housing. So we'll have to wait and see.
Yes. Excellent. Well, thanks, Chris. And then the Fed met this week, right? And Powell and the Fed voted to keep rates set where they are, and they say they're in really no hurry to lower rates. But then they said at the same time they're expecting to have 2 rate cuts this year, so they're trying to signal that they're going to do rate cuts. But then they're saying we're going to keep them, set for a little while, because I think if they lower them right away, they could ignite inflation, or they would ignite inflation fears. So by saying they're going to do 2 rate cuts, then that'll help the markets, but it doesn't cause the inflation, right? So they're kind of trying to have it both ways. I'm a little confused by the Fed, frankly. Some of the things they're saying. They raised the inflation forecast to 2.7 from 2.5, partly because of the tariffs, but then they're saying, well, inflation will be transitory, and that's a term that they used when we went through 2022, when the inflation rate went back up to 9%. And if anybody remembers, the very, very high inflation rates of the 70s and the early 80s were in the high teens. But if you recalculate based on the new method they're using, the 9% that we had in 2022 was in the teens as well by the methodology that they used back then. So we did get up to record levels of inflation, just different level of calculation. But now, so the Fed is saying, oh, inflation is going to be up. I think people are concerned about the tariffs, and I think politically there are people out of concern about the tariffs, and some are trying to use the concern about the tariffs for political advantage. And I think the Fed is kind of getting caught up in that a little bit, frankly, because they're talking about how their forecast is going higher, but then they're saying on the other side it's transitory, like it's not going to be around for very long. So we're not really sure what the Fed is thinking, and I think they're being a little confusing in their message. Then they said the Fed says the risk of recession is up, but it's not very high. So once again, we're getting at, yeah, it's this way, but it's also could be that way. So I'm a little confused, Chris, by the Fed. How about you?
Yeah, I mean, I think right now the hard part that they have is, we do have these tariffs in place, and that will have some trickle through impact probably on inflation. No one really knows how much. They can project all they want. And then the other unknown variable is these tariffs are, I mean, they could come, President Trump could come to an agreement, with Canada and Mexico this week, today, and those tariffs could go away. And, so what's the long-term impact? So there's so much variability there. Are they going to be in effect for a year, 2 years? That would be a very different scenario than they're only in effect for a month or 2 months.
Yeah.
So it's I think that's really hard for them to predict. So, puts them in a spot where I think they're just going to be really sitting and waiting. And I think, they're going to posture, they're going to say probably a lot of mumbo jumbo stuff that's going to try to, either appease the markets or kind of alleviate concerns, maybe things like that. But I think really what it comes down to is the hard numbers, and right now what we can see is the numbers look good. So I'm sure they're not going to lower rates or raise rates. I mean, I think from some of the economic things they're looking at least as of right now, we're kind of in a Goldilocks kind of zone that could deteriorate significantly the next month, 2 months, 3 months, who knows? But right now, so I mean, they're kind of, hey, we think this might happen, we don't know, and like you said, they could be resolved tomorrow. We don't know, but yeah. So I think it's really hard for the Fed as far as posturing, which Conversely, I think is one of the hard parts right now is that's why the market, another reason the markets are going down is it's hard for companies and businesses to plan when there's a lot of unknown variables out there. So,
Yeah.
I think it definitely is. It's a tough time right now. But as I said, it could be something that's over as quickly as even tomorrow, today, next week. There's a lot of unknowns there.
Yeah, and that's interesting, Chris. In economics class at University of Chicago, we learned a lot about modeling. And when after class in 2008, when the oil prices went to $144 a barrel, which is the highest oil price we've ever seen in America, we tried to figure out what that would be impact on GDP. And doing all the models, it's really really difficult. So there's so many variables that you can't really predict. And I think 58 variables, and we realized that we weren't even scratching the surface of all the things that could happen. So that's why they call economics a dismal science. There's a lot we don't know, and we just have to wait until we get all the data and see what the market's really doing. And the market will react to it whatever way they are. And when there's bad news and the market doesn't go down, that's what they call a bull market. And when there's bad news and the market goes down big, that's a bear market. So right now we're in a little bit of a bear market in the short run, a correction. But a real bear market is down 20%. So we're not down that much, but we're certainly seeing a lot of internal deterioration caused by the tariffs, the economic numbers and stuff. And Chris, Goldman Sachs cut their GDP estimate for this year from 2.4 to 1.7. So they're still saying positive, but they're saying 1.7 now. Fitch investment ratings cut from 2.1 to 1.7. JP Morgan increase the possibility of recession from 30 to 40%, but that still means a majority probability of not a recession. And so we're seeing this wide divergence between strategists, again, because of the variability of all the data. The Atlanta Fed is saying inflation is going up, but they had lowered their GDP now, and we mentioned this in a recent episode of this show. They were up positive, and now they're negative 1.5%. And it went down to 2%. It's back up a little bit, but they're still about -2 for GDP. So there's a big range of Goldman. The other firms are at positive. The ADP or GDP now, the Atlanta Fed is down over 2%. So it's anybody's guess at this point. So we'll just see how it all plays out. This is the longest expected recession I've ever seen. We've been talking about a recession now for 2 years. I think we actually might get one now. We'll see.
Yeah, I mean, and I think one little thing I'll just quickly point out is, the Fed, they're human beings, they're prone to human error too. So, just because, it doesn't mean they're going to get it right. They could move too early, move too late. There could be a lot of variables there as well. I mean, there's been so many times when the Fed tries to contain inflation or tries to beat inflation and doesn't go the right way. So there's always some of the unpredictability there.
Yes. Well, and one reason why the GDP numbers stayed higher for longer, a big part of the economy has been a recession for quite a while. At least about a third of the economy has been negative growth. But we've had major spending from Washington running $2 trillion deficits. Well, now that seems to be going away. So the Doge committee, along with the new president, they're in there slashing and burning. And, they're doing it with a bit of a zeal that's bothering some people, certainly. Unfortunately, tens of thousands of people are going to lose their government job. But at the same time, there are a lot of people not even going into the office. They weren't even working. So they are trying to find ways to cut unneeded spending. And our government certainly got bloated. And so they're working through that now. The Treasury Secretary Bassett, the new secretary, said 70 to 80% of the jobs that came under the Biden administration were government jobs. And they were either government or government adjacent, like healthcare, that's very heavily subsidized by government, for example. And it crowded out the private sector. So now what they're trying to do is shift it. So those folks will go back into the private sector, because the private sector has a multiplier to it, and there's growth to the private sector, but there's no growth. Government is zero, it's negative growth, right? So the more jobs in the private sector, better for the economy. That's what President Trump is after. He's trying to shift more and more of the economy to the private sector and reduce government. In fact, today he announced the essentially complete gutting of the education department. It would take an act of Congress to get rid of the education department. They don't have the votes for right now. but the education department is going to go away. And a big part of the commerce department is probably going to be downsized as well, and push a lot of that down to the states where it works, where they believe it works better. So now that said, many of the things they're trying to do in cutting spending to reduce that 2 trillion in deficit, there's now 75 lawsuits against the administration to try to keep them from doing some of the things they're doing that they believe they have their authorization to do. But there's a number of lawyers, and some people think it's getting very partisan. But we'll see how it all plays out. But there is, I know, a move afoot to try to limit what these federal judges can do, where one judge in some city in America can affect the entire economy and the decisions of a national, worldwide leader, or president of the United States. So there's going to be some changes there. But the mindset is changing. We're going from a government-centered economy to a private sector economy. And they did pass a spending measure, so there's going to be no government shutdown. And that was a smart thing to do. But there's a big war going on in the Democratic Party because some of the folks are mad that some of the Democratic leaders went along with that no shutdown thing. But I think that was the right thing to do. We don't want a government shutdown for sure. Consumers are worried. They're slowing down. And if you consider the gross domestic product is a function of C plus I plus G, consumer plus investment plus government spending. Consumer slowing down, investment is slowing down. We're seeing earnings coming through slower, and the G is going down, government spending. So if every element of GDP is going down, that means GDP is going down. We haven't seen the G, the government spending, Chris, go down in decades, really. It's always stayed up there.
Yeah, I mean, and that's unknown territory for a lot of people right now, especially is what impact, and they can model it a million different ways. I don't think anyone truly knows, what ultimately is that impact going to be. I think the hopefulness is, I mean, they use the word transitory, but that this period is transitory. And like you said, if the government spending goes down, once we get clarity, once maybe this tariff tit for tat, if you will, comes, to a conclusion there, that we see investment from the private side pick up, and that trickles into, spending from the consumer. I mean, that's obviously what we want to see. But I think right now, just with the uncertainty, I think signs are pointing towards probably a recession.
Yes. So that's kind of what we're seeing out there, Chris. You've got some other numbers as well, don't you?
Yep. Yeah. Just pivoting to the international front. Really, I mean, this is where I think it's kind of really interesting, some of the things going on here in Europe. So Germany's lower house of parliament passed a vote on a massive surge in borrowing that would potentially boost Europe's largest economy. So they want to create a 500 billion or half a trillion euro fund for infrastructure, and also to allow higher spending on security or defense. So that's going to be obviously potentially a huge boost to the euro. I think there's still a lot of hurdles they have to get through. So there is no certainty there, but the euro itself hit a 5-month high off the back of this, German spending bill. So I think that's something to keep an eye on. And I think overall that's good. Obviously, we've had some friction with some of our European allies as far as what their defense spending is within NATO, things like that. So it's good to see that people are kind of stepping up some of that defense spending, some of our allies. Pivoting over to China. We got kind of an interesting, so we're getting some better than expected numbers out of China. Chinese retail sales grew by 4% in January, February, which was an acceleration from December, January, which was 3.7%. So a nice spending seems to be picking up a little bit in China. And China also came out with a plan to hopefully, in their minds, boost consumption with measures such as increasing incomes and offering childcare subsidies. So, China continues. I think they've been at this for probably 2 years now, 3 years, really trying to reignite their economy and reboost it. Haven't really seen that yet, but we'll see if this is the magic trick that's going to work. On the flip side, we are seeing Chinese investors start to regain some of their risk appetite, but bad news for China where the investments are going. So instead of Chinese investors investing in mainland Chinese stocks, which is comprised of the CSI 300 index, they're piling into Hong Kong stock market, which is the HSI. And to show that, the CSI is only up less than 2% year to date, where the Hong Kong stock index is up over 20% year to date. So I think a lot of investors are really seeing the potential with the kind of trade war, tariffs going on between the US and China as a potential currency risk, things like that within the Chinese mainland. So they think they're better off in the Hong Kong stock market. So that, it'll be interesting to see how that continues and plays out. And if, are we going to get a little bit of a boost from the Chinese economy? On the commodities front, oil prices have moved upwards recently. I think it's on a 3-month or a 3-week rally now. It's off of increased Middle East tensions. The U.S. had strikes on the Houthis, and Israel moved back into Gaza and had some strikes. So we're just seeing some pop there really in oil prices recently. And gold just continues to rally. It actually hit new record highs of $3,028 per ounce. And that's off of not only everything that's been driving gold, but now you're adding in some of these Middle East tensions, things like that going on that always is usually a little bit of a proponent to the rise in gold as a safe haven. So really interesting, I think, news. And obviously some of these underlying factors are really what we're seeing play out on our numbers we talked about in the beginning, right? As far as international and commodities, what's causing this move upwards.
Well, we're looking for a completely different style of economy with the new president, Chris. So while in the short run things are a little negative, by asking countries and giving them incentives to build plants in America, trying to bring jobs back to America, we're starting to see that already happen. And we already saw Taiwan Semiconductor, the largest semiconductor maker in the world. They're building a massive multi-billion-dollar plant, I think bringing 40,000 people to the Arizona area. I was just down at a conference in Arizona this week and met some of the folks that are doing home building, and they just can't build homes fast enough for homes for rent or homes for sale in that whole area. So there's a lot going on. That said, the only other negative about it's fine in Arizona, obviously, because of that situation. But some of the hot real estate markets, because consumer spending is slowing down, have slowed down, like Austin, Texas, and Naples, Florida. Those are actually negative on the year. And then some of the old school markets are doing better, like our very own home city of Chicago, our headquarters city, is actually among one of the top 5 growth markets this year. And we haven't seen that in quite a while because the older cities are losing population and that kind of thing. But we just didn't get as hot, and they got way, way hot. Now those markets are slowing down. So we're seeing that across the board, that we're seeing some real estate weakness in a lot of areas. So,
yep. Yeah, I mean, it's a good to point out that, I mean, if people get priced out of a market, they're going to go to, where they can afford a home. And as we've talked about, there hasn't been a lack of people leaving Illinois the last couple of years. So when you have that, sometimes home prices are definitely more reasonable than maybe in Austin, Texas, or Naples or Tampa, where you had this huge influx of people, right, driving those prices up even more.
And the coasts tend to have more volatility in real estate prices anyway than the Midwest. So more steady, but not as much growth. But anyway, but that's it, Chris. I think that's all we have for today.
Yep. Yeah, I think that about covers the markets.
Well, watch everybody. So the Leadership Matrix blog post is on FourStarWealth.com. And if you hop on, you can sign up and get all of our blog posts. We did a really interesting piece on diversity and backgrounds of the new Congress that came in about a month and a half ago. So look at that. And then also a piece about our U.S. energy independence. Under the previous administration, they were more focused on solar and wind and electric and that. So they didn't really mention the fact that our country is independent energy-wise, and we're the largest energy producer in the world, but a lot of it is fossil fuels. And so there's a certain crowd of people that don't like that. Our new president, the old president, 41, Mr. Trump, he's a drill baby drill guy. So he loves the energy. He's opening up lands for drilling and all that. So we are very energy independent, and we're now exporting natural gas. They've done some studies that it doesn't hurt the environment. So we're exporting natural gas all over the world. So we have the largest stores of energy anywhere in the world in America. And so we have a whole piece about that you can see. Expect also some new podcast interviews. We're going to be doing an interview with a behavioral finance expert, and it's just more dissecting how people make decisions with their investments. And sometimes it's rational, and Chris, sometimes it's not very rational. That's how people think and how their minds think. And how you panic at the bottom of a market and you should be really buying, and you get crazy and giddy when the top of a market, you should probably be selling into that market. So we're gonna talk to a guy named Joe Hart, who's got some really interesting insights about how we think about investments. So we have a couple of other really cool episodes coming up, and I think we'll leave it there for today, Chris.
Sounds good.
Well, thanks everybody for being with us again on this great episode of today's Market Explained. We'll be back in a couple of weeks with market updates and also some great interviews to learn about the money, finance, investing here in America and worldwide. Thanks everybody for being with us. Over and out for today.